Hello and welcome to Portfolio Matters, weekly update, week 123. But before we get going, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Well, it was an eventful week in the markets, particularly for the Bank of England. But before we get going, apologies to those of you who were expecting a Discord with Rogue Trader this week. We've rearranged it to Wednesday, the 12th of July. Please put it in your diaries. And also, we're now entering the disrupted summer period. So Richard and I are hiking in Austria next week, and there will be no PM. The following week, I'm actually hiking in Germany, but I will attempt to get something out so we don't get too far behind on the economic data. But this summer is going to be disrupted. Okay, the news. Well, the big news was the Bank of England met and it hiked by an unexpected 50 basis points. Frankly, we have talked about this before, and I said they needed to get ahead of the curve, and they are attempting to do so because UK inflation earlier in the week came in hot, very, very nasty numbers. UK CPI, commentators were expecting it to fall into the range between 7 and 8%. It came out unchanged at 8.7%. And core CPI rose again. It rose from 6.8% to a new high of 7.1%. There is no evidence that the Bank of England has got inflation under control as yet. Elsewhere, UK GDP rose above 100% for the first time since 1961 and is not on a good path. We will show you the chart in a bit. In China, the economy is slowing and it has cut its prime loan rate further from 4.3% to 4.2%. And good news for the energy transition is that China has green lighted an experimental 2 megawatt thorium reactor. Now, I've been very interested in thorium for about the last 15 years, and everyone talks about it, but nothing seems to happen. Well, finally, China is building an experimental one. If that works, they'll build a full 373 megawatt reactor.
If I could just dip in there, that's really interesting because there's a company quoted in the US called Lightbridge. Is it Lightbridge? Something like that, and they are a thorium reactor company, and I don't have any shares in them, but they've been around for yonks, saying this is much safer than uranium reactors and so forth. And if you want to stop it, you just open the bottom and it all drops out.
Yeah,
and maybe this is the start of it.
Well, the thing is, Richard, I've been reading about thorium, these thorium molten salt reactors. Like you say about, how if there's a problem, you just open a valve at the bottom and all the molten salt, pours out. But then nobody's been building them. So it's just been, lots of hot air. Well, finally, something appears to be happening.
Yeah. Really interesting.
And elsewhere in the green energy transition, the Eden project has opened its geothermal electricity plant, which we talked about in previous weeklies. And that will create 1.4 megawatts at a cost of 24 million quid. And when you think that a wind turbine can produce up to 8 megawatts these days and costs a fraction of that, that is a very expensive form of energy.
I also wonder what the ongoing maintenance costs on it might be, Keith, over decades.
Yeah, and whether the output will decline steadily as they slowly use up the thermal mass down there. We'll see. Some charts related to the news. Well, UK inflation came in hot, and If you look down this chart, you'll see once again, it was very broad-based. And we have the worst core inflation in May anywhere in the world. The FT took Argentina off this chart, but apart from Argentina, we've got a bad inflation problem. And the market is now pricing in peak UK interest rates of 6% later in the year, in January next. We'll talk about that further in a bit. And UK 1-month rates are expected to be around 5.75% in March next year. So interest rates in the UK higher for longer. And this is UK's debt to GDP ratio. That is not a good trajectory when you think that actually back in 2004, less than 20 years ago, we had a debt to GDP ratio of around 40. The Bank of England comedy chart update. The Bank of England's inflation forecasts just don't seem to change very much, despite inflation in the UK massively missing all its forecasts. Actually, it's the same in the US. Has been cutting interest rates, actually steadily.
Can I just say that my response to those inflation projections, Keith, was silence, not because I don't have a view on it, but because everybody knows my view on it. I don't want to sound like a broken record.
We need to start a campaign to get you on the forecasting committee, Richard. Anyway, on to the data.
What's wrong with just being governor of the Bank of England, Keith?
Yeah. I don't think that pays enough, Richard, for your your lifestyle. Okay, onto the data this week. So public sector borrowing came in well above expectations. Expected at 4.9 billion, came in at 19.2. The only good news was the April number was revised down. CPI was flat, massively missing expectations. Month on month, it was well down on April, but again, missed expectations, coming in at 0.7% against expectations of 0.5. Core CPI was awful. It was expected to be flat. It rose to 7.1, and month on month, was expected to fall to 0.6%, it fell to 0.8%. That is not a good annualized number. RPI, and remember, RPI includes the cost of housing, and so therefore will tend to be sticky, because as interest rates rise, so the housing component of RPI also rises. Well, RPI came in at 11.3%, slightly down on April, again missing expectations. Month on month, missed expectations, coming in at 0.7%. The good news is that PPI, so input and output prices, came in well below expectations and has fallen very sharply. So input prices were only 2.9% year on year in May, and that massively missed expectations. Output prices only 0.5%. So we have had this debate in previous weeks about the relationship between PPI and CPI, and we'll show you in a bit some charts which attempt to suggest that PPI in the UK leads CPI by about 3 months. If that's the case, then UK inflation should start to come down in the coming months. Fingers crossed. UK consumer confidence recovered slightly in June, beating expectations and up on May, and retail sales in May beat expectations, coming in 0.3% month on month. In the EU, consumer confidence in June also recovered, although it remained negative. Construction output for April was positive at 0.2%. Okay, turning to the US, it's a light data week. The only thing we've had is the Michigan Consumer Survey. Take a look. That was good. So consumer sentiment continues to recover. And the really good news is that inflation expectations are moderating. So 1 year fell sharply to 3.3%, and the Fed will like that number. The housing market index for June bounced strongly, and the big data point this week in the US was housing starts. Now, we've talked about housing a lot on this podcast, and it is defying higher interest rates in the US, and the housing starts for May in the US were astonishing. So they jumped 22% month on month. We'll show you a chart in a bit. But the Conference Board leading index declined again in May. So the leading indices are suggesting the US should be entering a recession, and the contemporaneous data is pretty strong. And finally, in some quarterly data from the EU, and that was not reassuring for the ECB. So wage growth in Q1 came in at 4.6%, down on Q4, but well above expectations. Reminder, Christine Lagarde has stated that the ECB will continue to raise rates. And in the FT this morning, they were reporting that the German central bank governor was very hawkish on rates. Some charts, Richard.
Thank you, Keith. So you have UK CPI, horrible looking chart, as we've discussed previously, and very recalcitrant to increasing interest rate, the effect of increasing interest rates. UK CPI month on month, just unpleasant.
Yeah, I mean, you have to say these are secondary effects now. What really strikes me is that inflation month on month over the last 4 months has been well above last year.
Yeah, I think, I suspect that we're going to start to see wage growth coming through quite strongly. I mean, typically a 10% pay rise is approximately what's required to enable people to keep pace with inflation. Once that starts to get embedded, we're really going to have a problem. So you have a UK core CPI, which has reasserted its upwards trajectory. And there we are with the month-on-month figures. And really becoming entrenched, embedded in the economy.
Well, the thing is, Richard, one of the reasons we've had very strong inflation over the last couple of months, and we'll show you the breakdown in a bit, is that in April, minimum wage went up by 9.7%. So you'd expect this surge in prices in April and May, but hopefully that should be a one-off, he says.
Of course, but then we also, the oil price rise from the Russian invasion of Ukraine, the gas price rise was supposed to drop out. And effectively, it hasn't dropped out. Well, obviously it has dropped out, but effectively its impact has remained.
Yeah, but actually one of the sad things about UK inflation is the last couple of months we have really benefited from the fall in energy prices. And without that, it'd be even worse.
And the pound has been rising against the dollar. So UK RPI year on year, well, it is sort of still heading in the right direction. So fingers crossed. The UK output PPI continues to fall very sharply. I mean, there's a question though, how much does UK output PPI impact UK RPI and CPI? And UK input PPI, which again is almost zero.
Yeah, these are good numbers, actually.
Yeah. And this chart does seem to show that there's a correlation with a lag of UK producer prices and consumer price inflation, which suggests that consumer price inflation should start to fall sharply if that correlation persists.
Yes. As I say on the label here, believe. But, that correlation would not have predicted that CPI was essentially flat this month.
No. Core CPI versus PPI percentage change. So there's very little correlation in the US between PPI and core CPI. So that's different to the UK.
Well, we don't know. We've had this debate before, and this is CPI versus PPI. They use the data underlying is the same. It's just different weightings of the data set. So, is the relationship contemporaneous, or do we believe that chart which shows that PPI leads CPI by 3 months? Don't know.
The problem with this chart here is that we've got some data points at the start where there appears to be quite a tight correlation. If you look at 1979, that period around 1979, basically there isn't much of a correlation from 1979 onwards.
Yeah, well, they're just PPI is more volatile, but you're right. It seems contemporaneous, but this is the US. So
this is the issue, that you can produce multiple charts that show correlations in different time frames, but actually many of them are in fact spurious. You just don't know which ones are spurious.
Yeah.
And UK CPI industrial orders has just perked up very slightly, but it's it's showing that industrial orders are very much in decline. It suggests the UK, industrial production in the UK is only a small part of the economy now, but it suggests that part of the economy is not in a great place. UK consumer confidence. This is one of those charts, isn't it? It goes back to 2000, never really gets much above zero, but boy, does it get whacked when people don't feel happy.
Yeah.
And it has risen substantially over the last 12 months.
Yeah, but it's still pretty awful.
Yeah.
But it is rising, just so despite rising mortgage rates, etc.
I mean, a lot of this data is actually extremely partial, because we have this issue, which we'll talk about later. We have this issue where actually rising mortgage rates are affecting a small proportion of the population disproportionately large, in a disproportionately large way. So, although it obviously spreads out towards rentals. So, if you've got a mortgage that's going to be refinancing in the next 12 months, you're really worried. If you've got a 5-year fix, you're not worried.
Yeah. Yeah, we've got a whole section on UK mortgages coming up where we'll discuss this.
Yeah. But it's so consumer confidence is the impact of the Bank of England's interest rates is really focused on quite a tight group. UK retail sales year on year, and UK retail sales month on month. And then we have EU wage growth year on year, which basically is still in its upward trend, I would say. And EU construction output has been almost unchanged for the last year and a half.
Yeah, interesting. Again, construction sectors everywhere defying the rise in interest rates so far.
Yeah. Well, we understand why the US is, but don't really know why the EU is. EU consumer confidence, again, it's risen really sharply, but it's still pretty low. But it never gets above zero, as we've discussed previously. France services PMI for June, it's turned negative, which suggests the service sector may be slowing down in France. I mean, I read today that the Eurozone is now in recession.
Yes. Well, it's had 2 net quarters of negative growth of 0.1%, as we discussed previously. And that is a technical recession, but it's a very shallow one. Now, this is data out this morning, actually.
Yeah, so that's hot off the presses. German services PMI for June also falling, but not down to 50 yet.
Yeah.
And US Michigan consumer sentiment, I mean, it's low, isn't it? You have to go on the relative numbers here. It's low. And US Michigan current conditions, likewise, it's low. US Michigan 1-year inflation expectations continuing its very choppy downtrend. 5-year inflation expectations stabilized really around about 3% for the last year and a half. The NAHB housing market index soaring back up from its lows.
Yeah, this is National Association of Home Builders in the US. Amazing, absolutely amazing.
And there we have that huge spike in US housing starts. It's baffled everybody.
Yeah.
I mean, this is housing starts, not housing sales. I mean, I think we do need to remember that. So this is the house builders thinking we can sell these.
Yeah. Well, what's going on in the US is that everyone has 30-year mortgages, which they locked in at 2%, and they can't transfer these mortgages. So therefore, they're not moving. So nobody is selling their existing home. So there's a lack of inventory in the US housing market. And, houses are being sold because of this lack of inventory. But, we'll show you the chart in a second that very few people are taking out mortgages. So eventually you have to run out of cash buyers, surely.
I completely agree. I think the world has become used to such hyper low interest rates that these massive increases, proportionately massive increases, are going to have a very damaging effect on any asset market that relies on debt. Full stop. It's just a question of time. So using US housing permits, just continue, basically following up that trend from 2010. And the NAHB housing market index, single family homes broken down between present sales, future sales, and buyer traffic, all moving upwards.
But I mean,
future sales is just ticked up a bit, hasn't it? Looking at that chart.
Yeah, actually, I've labeled this wrong. It's not future sales remains weak. It's buyer traffic is very weak.
Yeah. Well, the one that's strong is present sales.
Yeah.
This is data excluding seasonal adjustments, which just basically shows that there's nothing particularly odd going on in the market.
Yeah.
It's a little bit less active than it was in the 1980s and 1990s, but nothing particularly out of the ordinary to see here.
Yeah, absolutely. Amazing that it's totally resisted the rapid rise in interest rates.
Yeah. And as Keith pointed out, US existing home sales are really, really poor. People aren't selling because if they sell, they have to remortgage. Then they take on a much higher mortgage rate. And therefore, the existing housing market is stultifying. It's US 30-year mortgage rate, which is sticking at around 6 to 7%. And the US housing mortgage market index even is showing that the market is very tight. That it is.
So nobody's taking out a mortgage, basically. The number of mortgages being issued, and the mortgage market index is both commercial and residential. You'll see it's really low. So how are these houses being financed?
Yeah, as you say, Keith, these cash buyers will disappear eventually because they will have satiated themselves, and then the market will truly grind to a halt. So the conference board leading indicator declined further. So that's the blue line, and the suggested, again, this is tricky to follow. Is there a correlation? There may be a correlation between these lines. There was a correlation with COVID, but there isn't much of a correlation anywhere else, I would suggest. Or there's a very minor correlation.
Yeah.
Only stock market, building permits, and initial job list claims were positive in May. So stock market, financialization of the economy, presumably. Building permits is powerful. I mean, you could argue that the building permits issue is actually, or the building issue is actually a consequence of the financialization of the economy, because a group of people have made enormous amounts of cash out of the financialization of the economy and are now investing in property. Question mark, is what's happening.
Yeah.
And initial jobless claims positive.
Yeah. So jobless claims are not really rolling over, but we'll show you the chart in a sec.
So this conference board leading indicator still forecasting a recession in the next 12 months. I think, as we discussed last week in some depth, the amount of government spending, which is fighting the fiscal tightening, the monetary tightening by the Fed, is keeping the US economy strong. Red Book retail sales, not much growth there. And US initial jobless claims, yes, it is higher, but and it's not particularly high. Be interested to see what looks like in relation to the last 25 years or so, Keith.
Well, the trouble is that chart is very heavily distorted by COVID, so it's difficult to read, frankly.
Yeah, that's a good point. And initial jobless claims, 4-week moving average is showing a distinct but relatively slow uptrend.
To answer your question, really, a recession is generally associated with weekly jobless claims of around 500,000. And so this is rising, but not really to recessionary levels.
Yeah. And continuing jobless claims are actually gently falling away over the last 8 weeks or so.
Yeah. Okay. So again, how do you reconcile the two?
Yeah.
Don't know.
And US continuing jobless claims.
Okay. So this is without the seasonal adjustment, Richard, and just compares 2023 to the average. And so it was below and now it is above. So, but again,
I like
enormously.
I like seeing non-seasonally adjusted data because you can draw your own conclusions as opposed to having them forced on you.
Yes, precisely. And a lot of people are pointing out that, seasonal adjustments have gone bananas because of COVID.
So our summary, UK inflation much worse than expected and really very negative news. Put the Bank of England and the Chancellor of the Exchequer and actually Rishi Sunak in a hole. Sunak said he'd halve inflation within 12 months. He said that 6 months ago, and it's not likely to happen. But with a general election coming up, they've got a real problem. And the Conservative government have got a real problem. The general election, admittedly, in the next, I think, is it in the next 18 months or so, Keith?
Yeah.
And UK consumer confidence and retail sales are also recovering, which also suggests that the Bank of England have more of a fight on their hands still. So in EU, wage inflation is quite 4.6, worse than expected. Certainly not consistent with a 2% inflation target, which, if we recall, was set by a New Zealand economist some 20 years ago, and is totally arbitrary. Recent services PMI for June suggests that the Eurozone economy is slowing, and Christine Lagarde has committed to raising interest rates in Europe further. The US economy is showing resilience and improving consumer confidence. It's a huge leap in new home starts, which one suspects has to be some sort of artifact as opposed to sort of a real economic change. Watch this space, I guess. Unemployment claims are slowly rising, and the leading indicator for the Conference Board is continuing to slowly fall. Well, actually quite sharply fall.
So once again, the leading indicators continue to forecast recession, but actually contemporaneous data shows that the economy is doing just fine.
Yeah.
Okay, thanks, Richard. On to one chart. Now, reminder that monetary policy works with a lag, and non-farm payrolls tend to decline around 12 months after the yield curve inverts. So that's when the bond market starts to forecast a recession. So the yield curve would forecast jobs decline starting in October. So more evidence that the economy should start to slow. The US economy should start to slow later this year. And on to credit crisis watch. So it was a bad week for regional banks. Share prices falling back. And we have warned on previous weeks that the crisis in the regional banks has not gone away. It is just bubbling away there in the background. Now, bank deposits, having grown for a few weeks, sharply declined in the week ending the 16th of June, as did loans and leases. So is that evidence that the decline in bank lending that we've been long forecasting is starting to occur.
I would say, looking at that chart, the previous chart, Keith, is that it's quite a noisy chart, but there is a noisy trend
Yes.
at the right-hand end.
Yeah, I agree with you. And US small businesses are reporting declining access to credit. And actually, that is a bad number. You know, it's only been worse on this chart pre-GFC. The trend is not good. As a result of those declining credit numbers, cumulative loan growth, and this does not include data to the 16th, is falling below median, well down on 2022. So the credit impulse will be very negative. And we're seeing rising defaults in leveraged loans, although not disastrous, not yet at the level of the great financial crisis. But you'll notice that in 2008, where the level of defaults was not that elevated, it really took off the following year, and we are outpacing 2008. And banks' willingness to make consumer loans is falling, and dodgy correlation is that. Does that mean that non-farm payrolls should also start to fall? And another dodgy correlation chart that I like is that loans and leases should start to fall because we've been tightening lending standards for a long time now. So there is a lag between tightening lending standards and actual loans and leases because businesses can pull down existing credit lines for a period. Richard.
Oh, thanks, Keith. I actually think this is quite a good correlation. And the reason I say that is, one, it's over a long period of time, and the correlation, you can see there is a correlation that persists over 30 odd years. And secondly, it's a correlation that makes absolute sense.
Yes, no, it does. But, you know, we see so many of these charts, frankly.
We do. Yeah.
But this one, you're right. Actually, I should have put dodgy correlation on the last one. This one's a good correlation.
This one should have had non-dodgy correlation.
Yes. Now, US auto delinquency rates are rising. And what's interesting is that they are particularly concentrated in the middle classes. So FICO scores are US credit ratings, and the higher, the better. So you see very few delinquencies in prime lending, but it's in the middle here. And that suggests a lot of stress for the middle classes, because one of the last things you default on is your car loan because you need your car. So in summary, credit conditions in the US are tightening, and that should start to feed through to falling loan growth. And are we seeing that now? We have had tightening credit conditions for a long time now. Defaults are rising. Will credit push the US economy into recession in the second half? We think so. Richard, Inflation Watch.
Thank you, Keith. You always give me the exciting bits to do, Keith. Okay, so that's next meeting. So the FOMC meets 25th, 26th of July. Bank of England, who only just met, 3rd of August, and the ECB, 27th of July. So we've got a month now before we have any significant central bank meetings. And this is the table which just shows with the latest data that we've got, and we've discussed the UK CPI core and RPI. And just the other data there is Japan, where CPI and core CPI both 3.2%, both down.
Yeah, but actually higher than expectations, and the Nikkei apparently took that badly.
Right. So this is a chart of core inflation in the US. Eurozone and UK, and it is persistently high everywhere. It's interesting, isn't it? The 2% target, which is somewhat arbitrary, as I said earlier, has been completely shattered. And we have moved, I think it's reasonable to say, we have moved into a new inflationary paradigm, which is it's going to be difficult to get it below 4%.
Well, the thing is, it depends. I disagree with that, Richard, in that I think it's a question of how much you tighten policy.
I completely agree, Keith. I completely agree.
Well, one of the things we discussed when we started this podcast was, how then we were talking about how inflation had been quiescent, and people were worried that, before the pandemic, people were worried about you can never get inflation back up. But suddenly the central bank was, doing QE and cutting to zero at the same time that governments were doing fiscal. And we said the combination of the two is going to set inflation off like a rocket. And that's exactly what's happened. So now in the UK, we've had much fast rising interest rates, but fiscal is still loose everywhere. And so, in order to get inflation back under control, you need fiscal to be reined in as well as tight monetary policy.
And the interesting thing about the UK fiscal policy is that, as we saw earlier, UK borrowing is high and is not showing signs of falling. And that's with very high tax rates. And it's with the government being hugely resistant to public sector pay rises.
Yeah.
And so the government in the UK is trying to tighten fiscally. The Bank of England is tightening monetarily, and inflation is sticking up two fingers.
Yeah. And what I find funny about the discussion in the UK about fiscal is the Conservative Party are talking about tax cuts, and if there's any fiscal headroom, cutting taxes. And with the public sector borrowing requirements so high, I mean, that just seems ludicrous. You need to get the borrowing requirement down. The trajectory of UK public debt, as we showed you earlier, is just unsustainable.
So the ONS has this measure of inflation, which is consumer price inflation, including owner-occupied housing costs. So presumably that would include mortgage interest. So this is showing that there are reductions in food and alcoholic non-beverages, reductions in transport, but they're offset by increases in recreation and culture, restaurants and hotels particularly, but also in communication, health, and owner-occupier housing costs, fifth one down. So what we're seeing really is that particularly recreation and culture. Now, I know one of the issues with recreation and culture has been the huge increase in electricity and gas costs. In other words, heating, cooling, cooking, lighting, etc. costs for recreational facilities. And presumably that is being reflected here.
That's a really good point, Richard, because I was going to say that was the increase in the minimum wage. And it's probably a combination of the two.
Yeah.
So yes, month on month, you'd hope that will cool over the coming months.
Yes. And especially if these businesses were in fixed rates with their commercial energy suppliers, and those fixed rates have fallen away and they're having to renegotiate at much higher rates, or have been doing so, that should settle down. So what this shows is the major contributions to CPIH housing components. So we have electricity, gas, regular maintenance, water repair, water and sewage, council tax, rents. Interestingly, it breaks it down a little bit there. So you can see that the actual rate of inflation for this number is quite significant, isn't it? It's 3.5% to 4%, dropped down to 2 and a bit percent in recent months.
Yeah, but what's really important is that the big contributor to inflation has been electricity and gas. And on the 1st of July, that component turns negative sharply. because
Yeah.
the energy price cap falls from 3,280 to 2,074. So in July, so that number will be reported in August, you should see a very sharp drop in UK inflation.
So UK grocery inflation, I would say pretty much unchanged, really. I don't know what the sampling error is in these things, but looks to me like it's stuck at about 16, between 16 and 17%, which is really, really unfortunate, given that a lot of households spend whatever money they have left over after heating, lighting, and shelter on food. But the UK labour market remains tight, and the employment rate continuing to rise post-pandemic. More people are coming back into employment, which means the labour market should be loosening up because there are more people wishing to work. But in fact, the market is remaining very tight because there are presumably there's high demand for employment.
Yeah.
So we also have very high levels of economic inactivity. And if you look at the long-term sick, which is the maroon bars, that has not recovered from the peak in about July 2020. And we clearly have a significant long-term sick problem in the UK economy, which is problematic for two reasons. One, it puts a big stress on the NHS, and two, puts a big stress on the labour market.
You notice, though, the good thing about this is that student unemployment is really low. So tight labour market has been good for youth unemployment, but that long-term sick number, not great.
And there we have NHS waiting lists. So the median in blue, the millions in black. And, clearly there is a worsening, a rapidly, I would say, worsening problem. And that, as Keith says, is going to be contributing to the long-term sick problem, which is a drag on the economy. We got this extremely high food inflation index in the UK in blue, and actually that blue line is still heading upwards in the same direction as the Eurozone food price, whereas US food CPI is leveling off. Now, whether they follow the food price index remains to be seen. Presumably the food price index, Keith, is basically the raw materials as opposed to all the other costs that go into the...
No, the food price index is actually agricultural commodities. It's an index of agricultural commodities. And
yeah. So I guess the problem is, whilst agricultural commodities themselves may fall in price, that doesn't necessarily mean, after all of the other inputs that go into food manufacturing.
True. But it is a component.
It is a component completely, yeah. But it's the correlation, to go back to January 2010, there isn't much of a correlation, is there?
Well, the thing is, if you look at the dotted line, so they've lagged this by a year.
Yeah.
Well, they're hoping there's a correlation with a lag of a year, but a year just seems a bit arbitrary as well. You would hope there is a relationship.
And if you go back to 2010, it doesn't matter, the lagging by a year or not lagging by a year makes no difference. There basically is no correlation.
Yes. Yeah. Ignore that past the chart if you're an optimist.
Or if you, at best, there's a very gradual correlation where the two lines meet each other.
So what this chart shows is, in the kind of green and brown, is the percentage of UK companies reporting difficulties in hiring in green unskilled workers, in brown skilled workers. And you'll see there is a strong correlation with inflation. So this is the Bank of England's problem in one chart. In order to get inflation down, it needs to create some slack in the labour market. And currently, as we showed you previously, the UK labour market remains very tight. So the Bank of England needs to keep on raising until it achieves something.
So the problem with the, as I alluded to earlier, the problem with the, if you go back to the 1970s, I'm just going to talk about the UK now. The interest rates in the 1970s were raised very significantly to bring inflation under control. My question is, what was the proportion of fixed rate mortgages in the 1970s? I suspect that it was very, very low. And therefore, raising interest rates would have an immediate and broad-based effect on homeowners and renters. But now we have, as we know, we have most mortgages are fixed rate. And as long as you're on a fixed rate and you have a decent period of time before the fix comes off, you don't worry. One, you don't worry about the increase in interest rates, so it doesn't affect your behavior. And two, you're not impacted by the increase in interest rates, so you have money to spend. So we know there's a lot of fixed rates coming off this year, and that's going to impact 1.5 million households. So it's almost like the Bank of England has laser focused on a small group of the population to address a broad-based issue, and which means the policy that was effective 20, 30 years ago doesn't work now.
Well, actually, the thing is,
it works like a slow-moving sledgehammer.
Yeah. Well, first of all, we have a section on mortgages coming up, and we'll talk about this. But essentially, the Bank of England's only got one tool, one hammer, and so that's all it can do.
Yeah.
Yeah. So,
as a policy, it's a failure.
Well, so far, but
I mean, ultimately it won't fail because it'll bash the housing market to smithereens.
Not just the housing market, just because the other component is commercial loans, etc. If you want to do any investment, the bottom line is it's investment. Any form of investment gets hammered.
But with this huge lag.
Yeah, with a huge lag.
Like another example of the Bank of England not understanding how the economy works. They didn't understand the effect that interest rate rises would have on pension funds who were leveraging up and suddenly got caught out, leveraging up on government debt, and got caught out last autumn. They don't understand the housing market, and the interest rates don't affect the housing market without a huge lag, and the debt market. And the policy fundamentally is so slow moving that it doesn't actually do what they want it to do.
Well, the other mechanism, Richard, is that, and we've discussed this with regard to the US, is that mark-to-market losses on all financial instruments because your discount rate is higher. So if you have to mark your existing loans to market, you will incur losses. And because of the UK economy is so financialized, we all have a lot of debt. As that comes up for refinancing, we're talking about auto loans, we're talking about credit card loans. The rates on all of that has gone up, and as commercial loans start to be refinanced, so it will slowly. And I totally take your point about it having a lag. It will slowly suck money out of the economy and slow the economy.
It will do, and it will inflict an extraordinarily large amount of pain on a small group of people.
Yes. Actually, more on that later. You might be surprised by how little effect it's having on mortgage holders. Stay tuned.
So this chart's getting back to the topic in hand. Sorry for the digression there. This is showing that Eurozone broader inflation pressures have eased and are continuing to ease.
Yeah, and once again, this is assuming there's a big lag between PPI and CPI. So the green line is essentially PPI, and the black line is CPI. So, lots of commentators assuming that the two are not contemporaneous. I hope they're right, is all I can say.
So in the US, we've got core services ex shelter below its 10-year average in May, which is, and then prices paid and prices received indices also continuing to fall, and prices received dropping really quite sharply into negative territory. And UK inflation is very high. If there's a 3-month lag between PPI and CPI, we should see it starting to fall quite quickly. Yeah, fingers crossed. I maintain the Bank of England doesn't understand how the economy works, doesn't really know what it's doing, is panicking, and it's. I do rather suspect that these events are going to result in the redefinition of the role of the Bank of England in the UK economy in due course. To my mind, rightly so.
Is this your pitch for the job, Richard? You should write it up as a manifesto for next week. On to recession watch. Thank you, Richard. Okay, so the yield curve, this is US yield curve, is a very accurate forecaster of coming recessions. And that is a huge signal. You see, in previous recessions, it's gone slightly negative. It's now gone huge negative. So if you believe that the US will escape with a soft landing, you have to believe this time is different. And frankly, that just seems a very big assumption. So, people buying equities, etc., believing that the US will escape with a soft landing and that earnings will recover in the second half of the year. I think the risks are to the downside. And this is Nordea's GDP model, and they are very strongly indicating an imminent recession in the US. And US CEOs agree with them. So they're pessimistic about their company's future earnings. In the EU, Nordea's forecasts showing they expect a deep recession. And I showed you this earlier, but the Conference Board leading indicator is strongly negative and is at a level associated with recession. But some commentators are now saying that the US manufacturing cycle is bottoming. Now, we look at sales versus inventories. There doesn't seem to be very much evidence of that. This is data to April, but you'll see that inventories are elevated and sales are falling. If you look at that inflation adjusted, you'll see there's quite a big gap between the two. So why should manufacturers start to have to go back to work when companies have all got excessive inventory? Now, the Philadelphia Fed Services survey, which is obviously an extremely volatile number, and one data point does not necessarily indicate a trend, but it shows that employers have started to cut staff, and that is a big drop. Now, it is a volatile number. And I thought this was interesting. This is the change in seated diners month by month over 2023 versus 2022. And you'll see in the start of the year, there was a very strong rise in dining out, actually everywhere, but particularly in the US and the UK. And now we are down year on year. So are consumers really starting to cut back? And you'll see the trend is deteriorating absolutely everywhere. Talking about goods demand around the world, Taiwanese export orders to Europe continue to fall, down 35% year on year. Big numbers.
And in recessionary territory.
Yes, absolutely. And the Philadelphia Fed non-manufacturing index was weak. Current activity below zero and future activity falling. Now, we've talked previously about excess savings from the pandemic in the US. Now, JP Morgan are forecasting that they think the excess savings will be exhausted by October. And all that adds up to, difficult second half and final quarter for the US economy. That said, Atlanta Fed's GDP now is slowing, but still pretty decent. What's interesting is I hadn't realized that actually the St. Louis Fed has its own GDP nowcast, and that has gone negative. But US payrolls remain strong, and there's very little evidence from the employment data that the US is entering a recession. So in summary, the yield curve is strongly forecasting recession in the coming months, or next 12 months. Leading indicators continue to forecast recession, but contemporaneous data in services in Europe is rolling over, and there's some indication of that in the US, but everywhere the jobs market remains tight and there is little immediate evidence of recession. Okay, on to the UK yield curve. Now, I have previously said that I think the UK yield curve has become unanchored. Now, what do I mean by that? Well, short term, i.e. 1 year or 2 year, UK government bonds should yield the average interest rate over the period to maturity. And if they go higher than that, then banks should be able to borrow from the central bank, buy the bonds, and lock in an excess return. So any excess yield should be arbitraged away. Now, why should bonds become unanchored? Well, if banks are unable to borrow in sufficient quantity to arbitrage away the difference in yield, then bond yields will become unanchored from interest rate expectations. And in order to anchor the entire yield curve, you would basically have to borrow vast amounts of money and buy 30-year, 20-year bonds, and that's just can't be done. So at some stage out on the curve, yields do become unanchored. But the UK is a major financial centre, and it's odd that I think UK bond yields have become unanchored over the 1 or 2 year period. And the reason that I think they've become unanchored is that if you look at implied interest rates for January to March next year, they're saying that UK interest rates will hit 6%. I just don't think that's true. I don't think that so far the interest rates have risen very quickly, but if we believe that UK inflation should start to come down over the coming months, then I can't see the Bank of England doing another full 1% in rises. Now, let's take a look at Turkey as an example of a country where bond yields are very much unanchored. So you'll see the Turkish interest rate is about 8.5%, and it has been actually falling, whereas the Turkish inflation is 40%. So if you look at the Turkish yield curve, you'll see that 2 years out, Turkish yields are 14%. Now, if Turkish 2-year rates were anchored to interest rates, then you'd expect them to be about 8.5% or something like that, but they're not. And if you then back out from Turkish 2-year rates, the expected bank rate in year 2, then you'd get around 20%. So by imputing Turkish interest rates in year 2 from the bond yields, you get 20%, and that's just not going to happen. What it shows is the Turkish yield curve is unanchored. And if we return to UK rates, that's what we're doing here. We're taking the actual yield in the market and trying to impute what we think UK interest rates will be by bond yields. And just like Turkey, I think that what's actually happened is UK bond yields have become unanchored. Richard, mortgage rates.
Thank you, Keith. That was interesting. It's always concerning when we start to compare our economy with the Turkish economy.
Yes.
Not necessarily invalid, though.
Mm.
As I think we probably all know, there's a large number of fixed rate mortgages with interest rates paying at less than 2.5%, which are coming up for renewal and which we'll have to renew at 6%, maybe, depending on what banks and building societies offer. There we go. You know, this is what currently, if you come off your 2.5% or lower fixed rate, you're going to end up paying 2 and a bit times your current interest payment. In the popular press, there's a lot of confusion between principal and interest.
Mm.
So we've got a forecast that 30% of households will be insolvent if UK interest rates remain at 6%.
If this is the National Institute of Economic and Social Research, and you're saying that, you know, at any given period, they think that 13 or 14% of UK households are insolvent anyway.
So this is a spurious analysis by the National Institute of Economic and Social Research, suggesting that 30% of households will become insolvent if UK interest rates stay at 6%. It's obviously assuming everything else stays unchanged, which clearly is invalid, and just makes you wonder what economists actually do with their time.
An excellent summary, Richard.
So the aggregate increase in mortgage payments at around 3% of income looks manageable, but of course, it is not an aggregate increase. It is a focused increase on specific households.
Yes, very good.
Mortgage interest payments are not spread evenly across the population.
This is really interesting because what Richard has just been talking about is how, you know, we know that a lot of UK mortgage holders are having to remortgage from rates below 2.5% to new rates at around 6%. So you'd expect the aggregate amount households are spending on their mortgages to rise, and that's not happening. The black line is what you should be looking at. Regular payments are not rising. What's happening? So, and if you look at households' mortgage repayments as a percentage of their income, it's pretty stable. So we have talked many times about how rising interest rates will cause households to have to spend more on their mortgages, which will cut down demand. That's not happening. And what's happening is instead mortgage holders have reacted to higher rates by, when they come to refinancing, increasing the length of their contract to keep their mortgage payments stable. And there's plenty of scope for that to continue. Actually, some mortgage providers are now providing mortgages that expire when the borrowers are age 75 and above. So one of the ways that banks are reacting and keeping borrowers in their houses and not under financial stress is allowing borrowers to increase the terms of their mortgages.
That's interesting, Keith. So we see here that according to the Institute of Fiscal Studies, 19% of UK adults will pay more than 20% of their salary on mortgage payments if rates remain at 6%. If that is manageable, then it means that interest rates will need to go up for the Bank of England to achieve its policy aims using interest rates alone. They'll have to go up substantially more.
Yes, good summary. That's all you need to know. The monetary transmission mechanism is slow, and this shows that mortgage holders could expect to cut down their demand because their interest payments are going up. Well, they ain't. And more on UK housing. So we talked previously about how rising mortgages should slow the UK housing market. But what's been really interesting is the UK house builders' share prices have done okay, much better than expected this year. And they've been reporting sales which have held up, at least until recently. So I couldn't find data on housing affordability in the UK. So I did my own calculation. And this is the BBA mortgage rate, which is a weighted average of mortgage rates and includes a lot of the standard variable rate, and therefore is above 2 and 5 year rates you find in the market. Okay, so let's do a calculation. The median UK salary for a full-time employee is about 31,772. And the median house price, 285 grand. Now let's assume that there's a loan to value of 75%, which gives you a mortgage size of 214,000. You borrow for 25 years, you're a first-time buyer, you have a repayment mortgage. We've got the HSBC mortgage rates down here, and so the 2 year, it's 2 year fixed at that rate, and then you go on to the standard variable at 7%. Your 31,772 equates to 25,600 after tax if you make no additional pension contributions. And that means that a first-time buyer trying to buy a house with just their salary, using the median salary for the median house price, you're paying 61% of your salary. And that assumes that you've got a 25% deposit, which equates to £71,000. Bear in mind that your salary as a median worker is 32. So you've already done a vast amount of savings, or you tapped your parents for it already. Now, so what we're essentially saying is that in order to afford the median house in the UK, you need to be a couple both earning the median wage and willing to spend 30% of your salary on mortgage payments. This is an alternative plan for paying 60% of your salary.
Actually, if I could just chip in here with a little bit of a promotional comment, Keith is launching the mortgage payment dating app next week.
Yes. Yeah. UK Barclay Homes this week warned that they expected a further 20% drop in sales in the coming year. And I just think that the housing market mystifies me. It's all cash buyers, because actual proper salaried workers just can't afford the houses at these interest rates. And on to other charts, Richard.
Thank you, Keith. So it's interesting. The first one is ESG is good for a laugh. Apparently, Philip Morris scores well because it is good at disclosure. So Philip Morris is very good at environmental, social, and whatever the G stands for, I forget. Because government, they give, not because it produces cigarettes, which clearly is very good, but it tells people it produces cigarettes. So I was interested. So apparently, I'm going to make part of this up, and part of it is true. So in earnings calls, S&P earnings calls, the recent round, 20% of the S&P 500 companies use the term AI. And the rate of usage of the term ESG in these calls is falling dramatically fast. So basically, it's the next big thing. So ESG was the big thing. It was always nonsense in the way it was promulgated, and it's proved to be nonsense. And now it's AI. Yeah.
So, killing people is much better than building electric cars, according to ESG.
China's birth rate continues to decline rapidly. It's the 5th lowest in the world at 6.8 per 1,000 people per year. I don't know what that equates to in terms of approximate replacement rate, but I'm sure it's less than 1.
It's less than 2. 2 is reproduction. I think it's about 1.2.
Yeah. There we are then. Chinese population is going to halve over the next 80 years.
Yeah. And China will get old before it gets rich. Basically, you're now having declining population growth. And for a country which is heavily dependent on construction of houses, then demand for houses, just like in Japan, is going to fall off a cliff. So thank you to Draw It for sending this, which is from a website which shows what subsidy regimes first-time buyers in the US can get. And have a read. It turns out that first-time buyers in the US are eligible for loads of subsidies. And that may be contributing to the fact the US housing market continues to be strong. US fiscal largesse is propping up the housing market in many ways. And on to good news. This is interesting. So termites are the source of renewable energy because they convert cellulose into hydrogen. So termites can produce 2 liters of hydrogen from a single sheet of paper. It's amazing. Through the action of unidentified enzymes in the termite gut, lignocellulose polymers are broken down into sugars and hydrogen. So,
that is interesting,
yeah, coming to your house, an unwanted termite's nest as part of our conversion to the hydrogen economy. Richard, equities.
Thank you. Thank you very much, Keith. So it's a pretty bad week for equities. I mean, there have been much worse weeks, obviously, but FTSE All Share down nearly 3% and changed on the year. Stock Europe down 2.5%, still up on the year. The S&P 500 down 1%, still significantly up on the year. NASDAQ down 1%, still up 30%. And the Hang Seng, big drop, 5.4%. So Bitcoin had a very good week, up nearly 20% and up 80% on the year. And the pound down slightly against the dollar, but still up 5% for the year. The euro down slightly against the dollar, just about almost unchanged actually for the year. The dollar index faffing around 0 for the year. The VIX fell another 7%.
Yeah.
And is now down nearly 40% at 13%. So actually at a level of 13.5. So the VIX is suggesting historically that the S&P 500 should be sold. So there we have the FTSE All Share. It's now actually basically it's sort of repeating its long-term performance, isn't it? It's going nowhere.
Yeah.
Still. The stocks Europe, and yes, it is up despite the slowing down of the EU economy and the interest rate rises. And then we have now I like the new green graphs, Keith. They're rather attractive. The NASDAQ is it's actually got a slight parabolic shape there, which is interesting. And the CNN Greed Fear Index is nicely into extreme greed. A year ago, it was in fear. So shouldn't really buy the market at times of extreme greed. It's a bit of a contrary indicator. And it's AI-related stocks. It reminds a little bit of the internet bubble of 1999.
Yeah, completely agree. So I don't know how they defined AI stocks in this, frankly. But, if you take away AI stocks, the S&P is going absolutely nowhere.
I remember Fife's, the banana importer, in 1999, they announced, this in the middle of the internet, to melt up, they announced that they were going to be developing an internet system for managing and importing bananas, and their share price rocketed. I think they subsequently went bust, actually.
Yeah.
But AI is the same thing. The problem with AI is that it's like all these things. the competitive advantage, one or two businesses may get a supreme competitive advantage from it. Most businesses will have to introduce whatever the latest technology is in order to stay stable with their competitors. And so everybody improves productivity, improves performance at roughly the same rate.
Yeah.
So it may well change society, but it's not really going to change those businesses that much. So in the US 3-month Treasury rate that has stormed up, as a 3-month T-bill now has a higher yield than the S&P 500. So why own equities? Because you're expecting capital appreciation that you won't get on the 3-month T-bill.
Exactly.
And the equity rally has broadened out. It's not just those 7 companies that we talked about a few weeks ago. US profit margins remaining very high by historic standards, and not really, they need to, they're still on just on that trend line. And we have, in terms of multiple expectations, that's expected to continue.
Well, sorry, this is profit margins. They're expecting profit margins to, continue to rise again.
Yeah. And analysts suggesting that the earnings recession is over, and they're boosting their forecasts again. And it just makes the assumption that there will be a soft landing.
Yeah, to me, this is just a huge assumption. All the leading indicators forecasting recession and slowdown, and analysts are saying no, earnings are going to increase. Yeah. And actually, when reality hits, that's when the stock market rolls over.
Yeah, I think so, Keith. So liquidity, which is quite interesting, US liquidity in blue is falling away quite fast. And is the S&P going to follow it down? We will see.
We will see.
There is quite a decent correlation on that chart.
Yeah. Okay, on to commodities and energy commodities. Thank you, Richard. So poor week for energy markets. Brent down 2.5%, WTI down 1.7%. Natural gas futures, having had that enormous bounce last week, are fading again. So Dutch natural gas futures down 7%, UK natural gas futures down 8%, down 52% for the year. US natural gas futures, however, continued their bounce, up 1.6% on the week and now down only 41% on the year. Coal continues to fall sharply, down 8.7% on the week, down 68% on the year. Uranium, having had a very good few weeks, faded by 2.2%, but is the only energy commodity up on the year, up 15.5%. Numbers specific to the oil market. Well, overall, total barrels in the US fell by 400,000, but excluding the SPR, they rose. So that means the SPR was releasing barrels again last week. US crude production overall fell by 200,000 barrels. So the US is not sustainably increasing production. Baker Hughes rig count fell by 4. Okay, this is crude. Despite the falling rig count, crude continues to weaken, is back towards its lows. Now, Chinese imports of Malaysian oil continue to rise. And I now think the black line is Malaysia's actual oil output. So, yeah, draw your own conclusions.
It's oil from Malaysia. Well, oil whose last stop off was Malaysia.
Precisely. Now, what's interesting is Chinese oil inventories are rising. So the Chinese oil market is oversupplied. So everyone who is expecting rising Chinese demand to prop up the oil market doesn't look like that's going to be the case. European natural gas futures, having had that enormous bounce, have faded again. Same in the UK. Now, the UK is the top destination for US LNG cargoes. Some of that is re-exported to Europe. But I saw in the FT today that the pipeline through Ukraine, which supplies the remaining Russian gas supply to Europe, is likely to close when its contract runs out. And that supplies about 5% of Europe's natural gas. So in coming years, we're going to be increasingly dependent on liquid natural gas, which is expensive. This is US natural gas futures. That seems to be sustainably off its lows, he says. Coal continuing to fade. Uranium, having had a very sharp spike, is coming off a bit. Now, the Bank of America thinks the uranium price will continue to climb. Richard, commodities.
Thank you, Keith. Aluminium, fairly big fall on the week, 3.3%, down 7% year to date. Cobalt seems to have settled after dropping 43% year to date. Copper basically unchanged on the year and bouncing around that point. Chromium down a bit, 10% on the year. Iron ore down a bit, but pretty much unchanged on the year. Lithium, this is Chinese lithium. It seems to have settled down, having sustained a big fall first part of the year. Neodymium unchanged for a week after big fall. But nickel, a large fall on the week, very large fall on the week actually. Seems just very volatile. Tin up 2%, one of the few rises for the week, 10% on the year. Ferrovanadium unchanged, and zinc down 3.5%. I mean, a general downward trend in industrial metals over the week, I would say.
So that
worried that economies are slowing.
Exactly. So that's the second week in a row we've had fading commodity prices. Previous to that, they'd had decent bounce, but that seems to be fading again.
Yeah. We have aluminium, cobalt, copper. This is showing that global copper inventories are low and are falling. We've been reporting on this for a while now. And the world is in a structural deficit of copper going forwards. Chromium, iron ore, lithium, neodymium, nickel, tin, ferrovanadium, zinc. And looking at the precious metals, bad week for all the precious metals. Gold down 2.3%, still up 5% on the year. Silver down 6% on the week. Platinum down 7% on the week. Rhodium down 3% on the week. And palladium down 8% on the week. So the catalyst metals continuing their significant falls on the week. The precious metals a bit soft, I would say. And there's gold. And Turkey's sold some of its gold over the past 2 weeks. And Turkey has some significant economic problems with its currency and its rate of inflation. So presumably that's to do with trying to manage that.
Yeah, which suggests that some of the recent weakness in gold may be transient while Turkey sells off its gold.
Yeah. Central banks generally around the world are continuing to purchase gold. Silver, platinum, rhodium, inexorably down, palladium.
Great, thank you, Richard. And on to rates, and another dramatic week in UK interest rate market, bond market. So we had further sharp rises at the short end as the UK raised interest rates by 50 basis points to 5%. So the 1 year is now yielding 5.2%. And that is up 2% year to date. So big rises in UK 1 year rates this year as the Bank of England has failed to get inflation under control. But further down the curve, we actually had falls. So you'll now see that the Bank of England has raised rates enough to get a negative sloping yield curve. Now, according to its forecasts, the Bank of England QT program is due to accelerate in Q3 when there's forecast to be lots of natural runoff as well as active sales. Will they really go through with that? We ask ourselves. Now, this is the Bank of England's gilt holdings. And on the right, it's the share of total supply. And you'll see that although it owns very large nominal holdings of short-term gilts, actually it owns a decent proportion across the yield curve. But finally, the bond market is believing that high UK interest rate will slow the economy and the yield curve is inverting. So this is UK 2-year. Has that peaked? No sign of it peaking yet. The 10-year, the market is coming to believe that actually very high short-term rates should bring UK inflation under control. That looks like a topping formation. And 30-year, that looks like it's topped, he says. US 10-year, not coming down. German 10-year also not coming down. So the bond market's not yet convinced that inflation is really under control anywhere. Italian, apart from in Greece, the Greek economy is doing well. So any change to your views, Richard?
No change to my views, Keith. And I just wonder at what point the energy commodities might be worth buying.
Not yet. I think when the economies go into recession, I've moved to hold on gold actually, because interest rates have surprised the upside. I mean, medium term gold is, very good inflation hedge, etc. But as long as the Turkish central bank is dumping its gold supplies, you don't know. And Turkey's in big trouble. This could carry on until they run out of gold, basically.
It could indeed, yeah.
So concluding comments. Well, dominating this week was UK inflation, which was terrible. Core CPI continued to rise to a new high, leading the Bank of England to raise rates by 50 basis points to 5%. Now, as we discussed, the fact that UK mortgage holders are adapting and increasing the length of their mortgages to offset the increase in interest rates and keep their mortgage payments constant means that, once again, the monetary transmission mechanism is diluted, which suggests the Bank of England will have to raise rates even higher. Let's see what happens over the coming months, but UK PPI has weakened a lot. Now, various commentators are saying that there's a 3-month lag. Fingers crossed. Let's hope that's true. US economy remains resilient, although leading indicators continue to weaken. The Eurozone economy, I think, is weakening, and it's already in a technical recession. What do you get up to this week, Richard?
Well, Keith, it's going to surprise you, but I got up to nothing, as usual. So I'm I was obviously a little bit affected by the decline in the price of precious metals, but I haven't made any changes to my portfolio. And I continue to sit on my hands. And we're in a funny sort of summer doldrums, or approaching the summer doldrums now as well, aren't we? And so I am no buys, no sells, and nothing really on my radar at the moment. So, yeah, how about you, Keith?
Well, how's your performance, Richard, given gold's come off? Have you looked?
Yeah, I'm down a few percent. I'm down a few percentage points now, Keith. Actually, for my own, so I have this long-term strategy that I'm following, and I don't find it particularly helpful to look at it every week. So I'm not doing that. It's part of managing the way I think about these things. So I'm comfortable with my portfolio. I'm comfortable with where I'm thinking it's going, and I'm just sitting here doing nothing.
You're a very
But
sensible
yes,
man, Richard.
it has been affected. Clearly, it has been affected by the drop in prices of precious metal over the last. I mean, gold is still up year on year. Silver is down year on year. So,
I had a poor week, but given the fact that UK inflation was shocking, and I've got everything in long dated bonds, not too bad actually, down 0.2% on the week.
And you don't count your interest returns on this, do you?
You do, yeah, no, because that is included. It should be included, because when the broker calculates the value of those bonds, it doesn't include the indexation. So yeah, including the indexation, that's not a great week. But I'm off my lows, and I think things are going my way. Frankly, this is going to be a volatile ride, but as you all know, I'm aiming to hunt some big game, and so you have to prepare to take some injury in the course of that hunt. No buys, no sales. Now let's talk about TR24, because I say last week we did the calculation of the yield on TR24, and it's surprising that the share price has been falling, because it expires on the 22nd of March 2024 at 100. And so you'd think as that date approaches, we will start trending towards 100. Now, what happened this week was that UK RPI came in at 0.7% month on month, compared to market expectations of 0.5. So that should mean bondholders of TR24 just got an extra 20 basis points, and you'd expected the price of TR24 to go up by 20 basis points, but it didn't. So I don't understand the pricing of this. And so this is the change on the day of TR24 when RPI was announced. This is the conventional gilt. So compared to the conventional gilt, the value of TR24 just went up by 20 basis points, but the price didn't move. Odd. And going back to our calculation and feeding in the May number, then actually that's wrong. That should be 0.7. But anyway, you're going to get RPI. If you hold it to maturity, you should get 6.8%. So that seems a very good deal, most of it tax-free. And this is as of this morning, so rising a bit. But on 22nd of March, it expires at 100. Okay, that's it. Reminder, no Portfolio Matters next week. I try and do something the following week, depending on what the Wi-Fi is like. But summer is here. Enjoy it. In the meantime, please can you press like and subscribe to the channel. And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.